I still think gold has the best risk reward. People who've been buying gold for the last 3 years have not been looking at the economic factors, and they've been price agnostic. Central banks are not looking at the daily chart to decide whether to buy or not. That traditional correlation between gold moving up equals higher risk equals more volatile stock market, I don't think it's logical. But are you really wanting to hold a US Treasury for 30 years? Commodity cycles are not the same as economic cycles. Commodity cycles are tied to...
Adrian Day, president of Adrian Day Asset Management and the portfolio manager of the Euro Pacific Gold Fund, joins us once more at the VRIC. Adrian, welcome back to the show.
Thank you, David, for having me.
Good to always see you in person. My first question is, how do we know as investors whether or not gold and silver are topping? For context, for the viewers who have been not following this channel or other channels, gold's at 5,000. We're near 5,000. Silver is still above $100 as we film today. And so many people have come up to my booth here at the conference live saying, hey, you know, it's a great time for all of us, but is this the top? I'm worried about that. I don't want to get into the market right now if you feel like this is the top. Some people have made 40 and slips and said, you know what's funny? They timed this conference with a market top. And I said, how do you know it's a market top? How do you know, Adrian?
Look, I'll start with the conclusion, which is we are so far from the top, in my view. So gold is a strange asset because, as its critics keep telling us, it doesn't have earnings and it pays no dividend. And so it's difficult to value in and of itself. We tend to value gold relative to something else. We value gold relative to the stock market. We value gold relative to the amount of debt in the world or relative to the money supply in the world. But it's difficult to value gold in and of itself, again, because it has no earnings and doesn't pay a dividend. So how do you know it's at the top? You look at fundamentals, obviously. More than that, you look at flows, and you look at sentiment. Now, you go back to 2011, the last major top, or 1980, the major top before that, you were getting massive flows into the gold funds. In 2011, GLD itself, the physical gold ETF, was trading at a premium, not just a one-day premium of 0.5%, but 4% premium for weeks on end. That shouldn't happen to a gold ETF. And the inflows were just massive. If I said to you that the GDX had net outflows for the past month, would you believe me? Most people are astonished when I tell them that. It's easy to verify. The GDX has net outflows for the last month and net outflows for the last 2 and 3 months.
Do you think that translated into higher share prices for the miners because that money went to the miners? Maybe that's what happened, or no?
There's some of that.
Yeah.
There's some of that. But the GDX is a vehicle that is used primarily by generalist and retail investors, not gold people like this. People at this show are already involved in the gold market, right? And it's wonderful to see the audience here, the participation so high, much higher than last year. But these are people who've already been involved in gold. I'm talking about the non-gold investor, the dentist in Oklahoma who's probably never owned a gold stock in his life, or the last time he owned it was 2011. Or the financial planner at Schwab who has no allocation to gold. When those people want to buy gold stocks, what do? They buy the GDX. So in flows, you can see, and you saw this in 2011, you saw massive inflows starting at about April, May, and they just increased all the way to the top in October when the thing was trading at a massive premium. So I don't think the sentiment, if you look at sentiment, I just don't think that this is not an overwhelmingly bullish sentiment among the broad investor mass.
Okay. Can you maybe just start by telling us what you're doing with your gold funds? Are you buying more equities, selling, taking profits, or holding?
Well, a gold fund, of course, a U.S. gold fund has to be fully invested at all times. So let's say what I'm doing with my separately managed accounts. You know, it's all very client specific, frankly. If I've got a conservative client who's 65 years old, 5 years ago he was 65 years old, when he opened the account and he had a 20% allocation to gold, I'm trimming that to get him back to 25 or 20%. No question. But if I've got an aggressive investor who says, here's 10% of my assets for gold, we are buying. So, I mean, I think the gold stocks are still very, very undervalued. And you know, the thing is, as the stock prices have moved up dramatically. But if the stock prices have moved up less than the increase in cash flow and the increase in the value of reserves, then they're not keeping pace.
Yeah.
And so if you look at a company, whether it's Agnico or whatever, I would say that Agnico today is better value than it was 2 years ago at half the price or less than half the price. And that's because the cost of mining, we're very fortunate right now, the cost of mining has hardly budged. And so when you've got the price of the product you sell go up, 2.5, 3 times, yet your costs of mining have hardly moved, then you have tremendous leverage on the price of gold. So if the price of gold doubles, your cash flow has gone up far more than twofold. And the value of your reserves, obviously this ounce of reserves has doubled, but when the price of gold doubles, you can bring more resource into reserves. So your reserves are growing. And so all these companies are much more valuable today than they were a year ago. And on various metrics, valuation metrics, they are cheaper today than they were 2 years ago.
Let's go back to miners in just a bit. Let's talk about the markets overall. I've heard the opinion just now on my own show. Somebody said to me, $5,000 gold, where any gold price movement above $5,000 signifies or implies much higher equities volatility overall. And I'm just wondering, well, gold and stock markets have moved pretty much in tandem ever since 2021 rather, in the last couple of years at least. It's gone down together in 2022. It's gone up together since 2022. If higher gold prices implied gold higher equities volatility, why hasn't it happened last year when gold went up 50% since the previous year?
I'm not sure that I understand the correlation, to be honest. I'm not sure why gold at 5,000.
Because, well, I think the logic here is that higher gold signifies more risk in the world, therefore more risk off for stocks, because traditionally gold is seen as a risk off play, a safety play, and all that.
Yeah, I would look at it in two separate baskets, and then you bring them together.
Yeah.
The reason gold has been going up over the last 3 years, the people who've been buying and the reason they've been buying are totally different from the traditional reasons. The traditional people who've been buying gold and the reasons they've been buying gold.
Okay.
So if you go back to 2000, obviously we had a lot of a new demand from China, but people were buying gold for economic reasons. Weakness in the dollar, low interest rates, higher inflation. People who've been buying gold for the last 3 years have not been looking at the economic factors, and they've been price agnostic. That's very important. So I don't think price agnostic, meaning they'll buy at any price. The central banks are not looking at the daily chart to decide whether to buy or not. Tether, which, as you probably know, for the second or third quarter of the year, last year, bought more gold than any central bank.
Yeah.
Excuse me. And they're price agnostic. Obviously, they want to get a better price if they can. And so that traditional correlation between gold moving up equals higher risk equals more volatile stock market, I don't think is logical. Now, having said that, I certainly think that the U.S. stock market is primed to fall. And the reason it hasn't fallen is simply because there is so much automatic money coming into the U.S. stock market that's going into passive funds.
Yeah.
All that 401k money, over half of it is in the S&P funds, right? And that money, as long as people are employed every month, that money is going into the 401k and it's going into the US stock market.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. Take a look at this chart then. If it doesn't mean higher equities volatility, what does it mean for inflation? So this is the 5-year break-even inflation rate versus the metals price. If the 5-year break-even, as you know, is proxy for inflation expectations, not actual CPI. And so with higher metals prices, do you think inflation expectations will rise?
I think so. I do think so. But I don't think the traditional economic criteria that people use to decide whether or not to buy gold, that's not why people are buying gold now. They're buying gold because they're afraid of what's happening in the world, the uncertainty, shall we say chaos, but the uncertainty in the world. And the fact that fiat currencies around the world, including the dollar, but fiat currencies are losing their purchasing power. And so people are buying the dollar, and it's nothing to do with inflation expectations, in my view. That may come, but it's not. The Central Bank of Uzbekistan doesn't say what's my forecast of U.S. inflation. That'll determine whether I buy gold or not, right? But people have been buying gold, and Tether doesn't say, inflation's going up, let's buy gold.
Yeah.
Inflation's going down, let's not buy gold. So the people buying gold are not concerned with the traditional economic criteria.
Would you say they're using it as either a treasury asset or a hedge against chaos?
Absolutely. Absolutely. And to preserve value in the face of deteriorating purchasing power of all fiat currencies. And this is not new. This didn't happen last year with the new U.S. administration.
Right.
This has been going on for years. But I think it's fair to say, I don't think anyone would disagree that nothing that Trump has done has assuaged concerns. But this started years ago.
Well, do you think that maybe higher gold prices and higher bond yields, rather, they've been moving in the same direction, that relationship will persist?
I think probably long bonds, yeah, because look, nobody wants U.S. dollar, nobody wants long-term U.S. Treasury, U.S. bonds right now. That's why Yellen issued pretty much everything at the short end, and that's why Besant is doing the same thing. Because, yeah, it's one thing to take a 3-month or 6-month and get 4.5% on the 6-month. But are you really wanting to hold a U.S. Treasury for 30 years at the current yield? I would say no one's going to buy that as an investment. Yeah. They buy it because they have liabilities that they have to match, like insurance companies, pension funds. But nobody's buying a 30-year Treasury because they think it's a good investment.
Okay. Whether you think it's going to be Kevin Hassett or Warsh, or now I think there's speculation that maybe somebody else will take the Fed chair. Either way, what is the direction of Fed monetary policy this year, and how will that impact the rest this rally that we've seen in the metals?
Is that a softball?
Once in a while, I got to throw one of these.
I mean, monetary policy is clearly going to be looser. And even without Trump and his new team, even under Powell, who's been relatively
right,
sort of trying to hold the line, monetary policy has been easing, particularly in December when they reinstituted the not QE QE.
How about this? Will they institute yield curve control such that they limit the long end of the 10-year and the 30-year?
I'm not sure, because at this point, I don't think they're overly concerned about the long end, because they're issuing everything at the short end. They can sell everything they want at the short end. Besant is a smart character. They're going to try and come up with other ways to get demand for U.S. treasuries. Most obvious one being stable coins. That's what the Genius Act was all about.
Yeah.
Was in finding a new source of buyers for treasuries. So when Tether issues a stable coin, a U.S. stable coin, they go out and buy treasury, right? And so promoting stable coins is in a backdoor way of promoting buying for U.S. treasuries from a new audience.
Right. Something interesting just I've noticed, maybe you can comment on this. Previously, we had Janet Yellen was Fed chair, then she was Secretary Treasury. Secretary of the Treasury. And then so there was a good relationship between the Treasury and the Fed during her term.
Yeah.
There's open friction now between Besant and Powell. Has that dynamic impacted markets at all?
I think it definitely has. I mean, there is this theory that I don't actually go along with, but that's a different discussion.
Sure.
But monetary policy should be independent of the administration. And so the independence of the Fed and the independence of central banks has been held as a sacred cow. Now, look, the reality is that every president for the last 20 presidents all the way back to 1914 has tried to browbeat the Fed in one way or another. Not quite as openly as Trump and Besant have. Biden didn't call him a moron and so on. But what's his name? LBJ, Johnson. He took Arthur Miller by the lapels and shook him and put him up against a wall. Now, this only came out 20 years later, right? But I mean, this friction, Trump hasn't done that yet. But
Maybe
I know.
It'll come out 20 years later.
But so friction between the administration, the Treasury, and the Fed is nothing new. But normally it's been it's been a little more subtle.
Yeah.
Or behind closed doors.
Have you noticed that most of the central bank, let's go back to gold for just a minute. Have you noticed that most of the central bank buying of gold that you commented earlier came from the Eastern central banks and Asian central banks? I didn't see the U.S. Fed add to their gold reserves.
No, well, you've seen some from Latin America as well. But I mean, the obvious reason for that is that most Western countries, Western European and the U.S., already have significant gold reserves. So if you're Germany with 70% of your reserves in gold, you don't really need to own anymore.
All right.
So it's the Eastern countries, the Middle Eastern countries, the Asian countries that were underweight gold to begin with.
So maybe we should look at capital, or not say capital, but flows in and out of central banks as an indicator of market tops. Once central bank buying eases, maybe that's when the market eases as well.
For gold, I think so. But as I say, there's other things. There's Tether buying now.
Right.
Now, Tether, Juan Santuri, the chief of global projects for Tether, who is in charge of this gold drive for Tether, he thinks that the gold stable coin will grow as rapidly in the next 5 years as the U.S. stable coin, backed by treasuries, grew in the last 5 years.
Yeah.
That's their goal, that's their target, even if he's only halfway right. That means Tether is going to be buying significant amounts of gold quarter after quarter after quarter.
The fact that a lot of the hard metals have gone up, platinum, palladium, copper, gold, silver, new all-time highs for silver, gold, and copper. Have you shifted your allocation of the types of miners that you're investing in because of these price movements?
Yeah. Well, first of all, I'll answer a different question first, if I may.
Yeah.
Have I shifted the commodities that I'm emphasizing?
Yes.
And the answer to that is definitely yes. So we're still buying gold. But I mean, copper is relatively undervalued to gold.
Okay.
But I mean, oil and gas. Oil is the most hated commodity on the planet. And I think the narrative around oil is just plain wrong.
Right.
We're still going to be using fossil fuels in 20, 30, 40 years.
Yeah.
I mean, the idea that we're going to be fossil free in 10 years is just nonsense. It's just not going to happen unless we want to go back to the dark ages, which weren't so dark. But anyway, that's a different subject. So oil, the narrative around oil is just completely wrong. But because it is so hated, because there's this narrative we're not going to be having any in 10 or 15 years' time, because the banks up until Trump came in would not lend to oil companies, because government pension funds and so on would not invest in oil companies, what did oil companies do? They did the rational thing and didn't invest in oil exploration. So oil has been incredibly underinvested. There's been underinvestment in oil and gas for the last 10, 15 years. And the thing about commodities we have to remember is the commodity cycles are not the same as economic cycles. Commodity cycles are tied to the investment cycle. Copper has been very underinvested for the last 15 years, which is why the copper price has moved as dramatically as it has. Oil and gas have been dramatically, significantly underinvested for the last 15 years because of this narrative, which is wrong. And the narrative that there is, which is put out by the International Energy Authority,
right,
because the narrative that there's excess supply is not true.
You're talking about oil now.
I'm talking about oil. Sorry. Yes, thank you. I'm talking about oil. Over 100% of the growth in oil in the last decade, the growth in global oil, over 100% came from U.S. shale. U.S. shale has peaked. That's a fact. That's not speculation or, wild talk or... You look at field after field after field. They peaked. Production has peaked and they're on the way down. Used to be thought that the downward slopes in shale would be very, very sharp and the tails would be very short relative to conventional fields. We don't know that yet, but we're going to find out. But regardless, they've peaked and it's on the way down. So the big question is, where is the future growth in supply coming from? Venezuela's one. But we're going to have to go back to the Canadian oil sands, and Venezuela's one. But you look at a lot of the conventional fields, Cantrell, North Sea, they're a shadow of their former self. And now shale, which was for growth, is declining. And yet demand for oil just consistently goes up. 2%, 2.5% year after year after year. So, I mean, I think that's enough on that, perhaps, but I think oil is very undervalued. Right now, lithium is very undervalued. So there's a lot of commodities that are undervalued relative to gold. So we're certainly putting more money into other commodities.
Yes.
I'm also putting more money into overseas stock markets, just generally. I don't know if you wanted to talk about that or not. Maybe you
absolutely,
don't. But you look at the U.S. market. The U.S. market, up until last year, the U.S. market outperformed the World ex-US, right, as a Morgan Stanley Capital International Index, World ex-US. So the US outperformed the non-US for the last 15 years.
Okay.
These cycles tend to be long. Before that, foreign markets outperformed the US by 8 years.
Yeah.
Last year, you saw the turn. The World ex-US, so foreign markets outperformed the US by almost 2-1 last year, almost 2-1. And you don't get that shift for 1 year and then it shifts back. So I think we're going to see, for the next probably 5 or 6 years, we're going to see overseas markets outperform the US. By how much? Let me just give you an example. The overseas markets would have to go up 2.5 times from where they are today, 2.5 times, to get back to their last cycle low relative valuation. Their last cycle low. So the potential for global markets to move up relative to the US, I think is very, very strong. Let me just say, January the 1st, global markets had never been as cheap as they were relative to the US market.
As a fund manager, how do you differentiate between something that is undervalued and has potential versus a value trap because it's cheap?
Good question. And there's also the question of timing, of course.
Yeah.
You can be right, but your timing can be off, because I could have looked at a graph of US markets versus the foreign markets, and 3 years ago I could have said, wow, they've never been as cheap as they are now. Yeah, that's always an important point, and you just have to look at fundamentals. We're bottom-up investors, right? We're bottom-up investors. So we look at individual companies from the bottom up. But as Warren Buffett said, I like to fish in a well-stocked pond. So you go to look for bottom-up opportunities in markets that look cheap. The British stock market right now, for example, up until last year, the British stock market had gone nowhere for 20 years. Nowhere for 20 years.
Yeah.
While the rest of the world was moving ahead, and of course the US was zooming to the moon. So the British market relative to other markets is certainly very undervalued. But dividend yield, the price to earnings, and the price to book of a British market is one of the cheapest in the world. It's a well-established market, well-established companies. Most of the companies there are exporters, so a weaker pound is not to their detriment. So we're finding a lot of good value there, for example. Okay. But there's other markets, Brazil, Singapore, Hong Kong. They're all markets that are lagged the rest of the world, have good valuations, and have good internal fundamentals.
Well, let's end it on this note. If you had to distill everything down to maybe your highest conviction buy for 2026, asset class or sector?
Well, look, everything I've said, notwithstanding everything I've said, I still think gold has the best risk reward for the next 12 months. Just on that note,
the fact that the gold-silver ratio went down in a vertical line from 100 to 45 in a matter of weeks, what's your reaction to that?
I'm not a huge follower of the gold-silver ratio, and I'm sorry if I offend anyone.
That's okay.
but you can look at it over the last 10, maybe 20 years. But I hear people looking at the gold-silver ratio in 1900. It's meaningless to compare it with where we are now, because the dynamics of the internal fundamentals of the silver market are just so dramatically different today than they were even 25 years ago. You look at the supply side of silver, where 25 years ago, 75 to 80% of silver was from primary silver mines. Today, the reverse is true. 3/4 of silver production is byproduct.
Yeah.
And it's mostly byproduct of base metal mines.
Right.
So the market fundamentals and dynamics are completely different.
Okay.
But clearly we all know this. Silver has moved meaningfully more rapidly than has gold. But again, if you look at silver on an inflation-adjusted price, it's still well below, 50% below its 1980 and 2011 highs.
Okay, great. Adrian, let's wrap it up here. This is a great summary. Where can we follow you for more information?
AdrianDay.com is the best place.
Okay, AdrianDay.com. We'll put that in the description down below, so make sure to follow Adrian down there. Always a pleasure to speak to you with you.
Well, thank you so much, David. Thank you for having me.
Thank you for watching. Don't forget to like, subscribe.